Hey everyone, welcome to another Market Radar podcast. Let's take a look at what next week has in store for us. Wednesday, we've got CPI and Fed minutes. Thursday, we've got jobless claims, PPI final demand. Friday, we've got retail sales. So it's a fairly busy week. There's especially Wednesday. Keep an eye out on CPI. That's what we'll be looking for. Let's see what the NASDAQ did this past week. We really didn't get much. We are at a trend exhaustion point, as we stated earlier in the week, after the NASDAQ ran up 12% from its March lows. The real action that happened this past week was in bonds. If you take a look at ZB, same with gold, both really pointing deflationary signs. And so we're going to talk about that a little bit today on what exactly this means. Same thing, we did see some moves in the twos and tens, especially after the jobs numbers that we got today. We are recording this on Friday, so jobs numbers just came out a few hours ago. And nothing too crazy, nothing really game breaking. We did see average earnings growth slowing a little bit. Jobs market is still hot, but mostly in line with expectations. So the market isn't really surprised with that. But it is showing us that the Fed possibly still has room for more hikes, and deflation might not be as close as the market thought it was, as you can see with the move here in the tens and twos. Same with the bonds, slightly reversing course. But we'll have to see how this progresses. We'll have to see what happens with CPI. That's definitely going to change market sentiment as well. But Gamma, let's talk about this deflationary question that I have. So as I just mentioned, the tens and twos pointing deflation, ZB pointing deflation, gold also pointing deflation, real yields also pointing deflation. There's so many things just lining up pointing deflation. It almost seems too obvious. It almost, I don't know if it's just because we really have been expecting this and looking at this for a very long time, but it really feels too obvious. And is there a possibility that this could be a fake out?
Yeah, so there's always going to be a possibility that at least this initial trigger point could be a fake out in terms of understanding where real yields will go and yields themselves and the twos and tens. We know that at some point, right, the twos and tens spread, which I have on the screen here, is going to revert towards zero. So at some point, we're going to get a deflationary event. Now, the question is this the start of it? And I think that the past 12 to 18 months, we've been very trained into this sort of pattern where the most obvious isn't the most likely, if that makes sense, right? It's anything that seems the most obvious is not going to happen, pretty much like a contrary environment. And
Right.
then yeah, we also have to take a step back and understand what everyone else is looking at, right? Because those listening, those following, and those that have been absorbing our content over the last just 12 months alone, you'll notice that we have a very different approach compared to the rest of the street. And when you um, absorb something, I should say, when you are really focused on something, you may think it's the normal. And typically, Aries, the system, and our views are not so much consensus in terms of like the way we think like everyone else, because our data, we're very data driven, and the data most of the time has a very contrarian take to what is floating around in the media just by nature. Because what ends up happening is you can take an analogy like the magazine covers of all these exorbitant CEOs that end up going bust. Is by the time it reaches the media, it's already old news. Pretty much like like this unemployment number, the jobs number that we just saw. The market has been expecting that somewhat, not to the obviously not to perfection, but the market knew that it had an idea that the jobs numbers weren't going to really accelerate in the way that they did just a few months ago, which that was a surprise. And obviously, the market's getting the direction and timing right rather than the individual prints. And if you don't pay attention to the data, you will actually end up looking at the data, thinking it's real time while the market's already forward thinking. And what that basically means is, as if you focus on the data, you almost have a slight glimpse into the future. So when we look at this data and we pay attention to what's going on, it might seem like, okay, it's this is too obvious to be true. But if we go back in time and we find any event where um, even in the twos and tens where there was a real reversion, it might have felt like it was too obvious at these times as well. If you were to bring yourself back then, it's very hard to look back because when you look back in time, you think, okay, you don't think, you tend to forget those feelings involved when you took those positions or you positioned yourself for those things. Meaning, um, the prior risk on trigger didn't make sense, but at the time felt like you were basically fighting the resistance. Oh, the market couldn't go higher from here. Um, there's all these bare reasons, and it ended up working. Now, the way that I see this deflationary event playing out is in such a way that the way the market's at least telling me it's going to play out is it's not going to be direct and upfront in one shot. For example, the jobs report pushed the odds of a 25 basis point hike in the next meeting, which is in May, up 17 percentage points to 67%. Now, we went into this jobs report just around half, I think around or slightly below 50% chance of a rate hike, 125 basis point rate hike. So the jobs report didn't really change the outlook in terms of the next meeting. But what it's doing and what we're starting to see this data do slowly is take away some of these dramatic rate cuts, meaning the odds for further rate cuts through the rest of 2023 fell slightly to a 67% chance we see a total of 3 rate cuts through December's meeting. So going into the jobs number, that number was closer to, I think it was like 88 or 89% chance we get 3 full rate cuts into December's meeting. So what we're seeing is not so much an acceleration in rate hikes, but more of a deceleration in rate cuts. So the again, going back to what the Fed has literally been telling us at almost every talking point and meeting that they've had, is that they are going to hold rates throughout the rest of 2023. Now, the elephant, or I guess you can say the issue with that, right? The thing that everyone is really focused on is, will the Fed be forced to cut? Because if they're telling you that they want to hold rates at steady throughout the rest of the year, the only reason that they would not do that is if there was a dramatic reason on why they couldn't do that. So
And do we know what that might be?
that
That
would
seems to be the black swan that nobody knows.
Yeah, that would be, in my opinion, that would be a rocket up in unemployment. If we saw like a 4.5, 5% unemployment print in the next like 2 to 3 months, or at least,
Mhm.
so the next meeting's in May, if and we're gonna get the unemployment report today, next week, right? I mean, excuse me, we got that this month for March, and next month we're gonna get the at the beginning of May, we're gonna get the April report, and then I think that report happens after the FOMC meeting. So the FOMC is going to meet before that report, and if like there was a major jump in terms of unemployment between this report, which we just had, and the May report, in the next meeting, in the June meeting, the Fed would most likely be faced with the the issue of having to cut. And that's why you almost see the Fed raising in May and then holding in June, and then the rate cuts start being the acceleration of rate cuts start being picked up after the June meeting. And that's because the May meeting is really, the market's almost telling you, if you look closely, the odds are flat for May because the the Fed doesn't have the next round of unemployment data to push in to the net into to basically factor into that meeting. Meaning, it doesn't have April's unemployment data for that meeting. It only has the data that we've just gotten today. So, in terms of
Right.
how they can price it in, it's very unlikely the Fed's going to move policy lower on a cut because something else. We would have to have a black swan like banking crisis or something in between now and that Fed meeting, because the unemployment data is already out. So there's really not much, or a CPI being like a really sticky CPI. But again, I don't see that being that sticky. We have base effects in our in our basically as a tailwind now. So until that tapers off, I think my personal view is that we're going to get more of a high. Or I don't even want to say it's not much higher, but for longer, rather than basically a one meeting terminal where the rates just decelerate after that. So
If we do get a situation where something does break, some black swan happens, don't you think the Fed might be a little bit hesitant to cut even if that happens to avoid a 70s type of situation with the double top in inflation?
of course, yeah, but it depends on. So you can already we can already say that. I mean, I guess it was obvious to some. It was obvious that hiking rates was going to be problematic for the banks, but the SVB situation wasn't in sense a black swan event.
How so?
Well,
Like it I guess it was a black swan to most people.
right. Like if we look at
Bankers and insiders obviously not.
yeah, but like if we look at KRE, right? Like this type of move is a tail move. This type of move, if we look at KRE, we're talking, in the matter of 3 days from we're talking about a regional bank index down 26% in 4 days, 2 trading days.
Mhm.
That's a tail event, right? So in terms of that, I think the Fed was able to basically take that incoming tail event and convert it back to basically normalize it via the BTFP, um, and just their base obviously the discount when all these things are attributes to that the Fed, or I should say tools that the Fed can use to take incoming tail events and convert them into or normalize them as the cycle progresses. Now there's certain things that they can't normalize, um, and that would obviously be an accelerated rate of defaults that grow from regionals, and that's something that I don't think we would see. But if that happened,
Mhm.
obviously it's extremely highly problematic, and in turn would be very bearish for the market and for the economy. But I don't think we're seeing that or even close to seeing that, at least
Yeah.
yet. So
Well, something I want to just say for the viewers too. So we are talking about uh, deflation as being a high probability. And just a disclaimer, our system is not telling us deflation. So it is something that we are expecting. We don't front run our system. The rule number one: do not front run the system, or else you get into situations like um, back in back in last year when bonds were rebounding. Everyone thought deflation was around the corner. We were also expecting it. I think it was in the July 2022 in that
oh, it was
rebound.
this rebound. Yeah, I
Yeah,
remember.
yeah, that rebound. Everyone thought, okay, this is it. This is done. Bonds will reverse from here, and our system was slowly picking up deflationary odds as well, but never flipped. It always stood its ground, and that's why we didn't front run it. We stuck to it, and sure enough, it was right. So now we're in a similar situation. Although ZB is a lot closer to Momo than it was back then, we're slightly above it now, but it's the same situation. We do not front run the system, and if it's not telling us deflation, then it's not deflation. We're not smarter than the system. The system looks at way more asset classes than we are able to track on a daily basis, and that's just what we have to go off of. So we do anticipate deflation, and we do come up with these theories on what is possibly going to happen, but we don't place a trade until everything lines up.
Right. And then on top of that, I mean, let's just take a broad based view at volatility, right? So VIX in the 18s is not something that we need to be so scared about in markets. Like obviously, this is you can take the other view that VIX would be only at highs if once the problem hits the tape. But in terms of trend following in VIX, we've said back in mid March, we said anything under 23s would be good for markets. And so far, um, it has been. Now, anything going forward under 2256 is going to be good for markets, meaning any dip in a market where VIX can't get above 2256 is going to be bought back up. So
Mhm.
I want to segue this conversation into what we've been saying the past couple of weeks on Twitter, um, and more definitively what we've been saying in the podcast is that what and bring this into what you were explaining earlier in terms of um, the mentality of deflation being too obvious. What isn't obvious, which is I have this strong feeling where there's a good possibility we will see, is a deflationary environment where both bonds and equities get the bid, meaning both bonds and equities go up simultaneously. Now, that is going to baffle and put many of these macro guys in shambles because typically deflation is the worst regime for most asset classes. It's just terrible. But in terms of what we've seen in the market, we have not had a recession yet in this economy. I don't care who you're listening to, I don't care what you're reading. There has been no recession in the stock market, in the economy as well. In the economy. But I'm going to repeat that. There has been no recession in the economy, but there has been a recession in the stock market. What do I mean by that? If we take the Nasdaq for example, and we go from peak to trough on the Nasdaq. The Nasdaq, and these are NQ futures, so this is the Nasdaq 100. It's not the composite, but you'll get the point. It fell 37.31%. So 37%, the Nasdaq fell. Yet there was no recession. But what ended up happening was the market again is forward looking. And for a brief period, we went into what was technically a recession, a technical recession. We had 2 negative quarters of GDP print, which even I at that point was saying, you know what, maybe the economy is moving into a recession and the stock market's right. The stock market was front running that. And I think it was around this time period. I believe it was like the May, June time where we were talking about this technical recession. We went over it in the podcast as well. What ended up happening was the economy was able to pull together and basically stay out of recessionary territory. And what ended up happening was the stock market front ran a scenario that did not happen, which is why the market, we've seen this violent reversal off the lows. You know, we're talking off of NQ lows, the lowest low to the highest high of 24.35% from October to April, because there is no recession just yet. But the question now begs, the components within the Nasdaq, they will obviously we have FANG outperforming, but even if we look at some other companies, and the one we like to bring up is Amazon, big company, $2 trillion, a $1 trillion market cap, $2 trillion at the highs. This is down from peak to current price. This is down 45, almost 46%. So did the stock market front run the earnings recession, thinking it was going to happen sooner? And did it overprice what was going to happen? Meaning, when the stock market was pricing in a recession, let's go back to Nasdaq, right? Back in this time period of April, May, inflation was uncertain. So the market didn't really know inflation was going to peak at 9.1%. And it also did not know where growth would go. So we have to estimate that the market was mishandling the forward pricing of both inflation and growth metrics at this time, almost pricing in what I think was a worst case scenario being baked into the market here in rather such a rapid time. I mean, we're talking, this is not COVID, I know, in terms of speed, but we're talking about a 33% move in 200 days. That's 143 trading days. That's 33% move in 6 months, basically, in the stock market. Most bear
Yeah,
markets, on
and now
average.
now now we're in like a position where inflation is known, the trajectory of inflation is known more or less, and Even the trajectory of growth is a lot more known than it was back then.
Right. And what you have to, and this is by all means, we're going to follow the system. And I've said this since day one of this podcast. We're doing the podcast for over a year now. And if you go back, you'll hear this many, many times. We will change our view with incoming data, not because we're afraid of being wrong. I will gladly tell you when I am wrong because it doesn't matter to me because over time I know the system will be right. So if I follow the system's outputs, I will be right. So I am telling you right now what the system is telling me. And as we go along, that view will change as we progress. And if you don't front run the system, it's very hard to make a mistake. Now, if I take the system data and I front run it and I make a mistake, well, that's no longer the system's fault. That's me. That's me interpreting the data the wrong way and basically forecasting my own data. Doesn't make sense to do. You're better off sticking with what the data says right now. It might not seem it might make you feel nervous, like, oh, the obvious trade is going to be, for example, the obvious trade is going to be long bonds. It's going to be long bonds. Well, no, not yet. It might feel like it, but hypothetical scenario, let's just say long bonds shoot back down to lower vamp and they never go bullish. Well, now you're caught long bonds in a position that you should not be in terms of a trend that does not exist because you're longing bonds in the anticipation it goes bullish trend. Yet if they don't go bullish trend and they go back down to the short-term lows, what do you do in that situation? Well, it's all left field at that point. You have to make something up and it becomes you end up putting yourself in consecutive losing positions where they don't make sense. You have no risk management procedure for them, and you end up just taking unnecessary losses or drawdowns doing it this way, which is why we don't front run the system. Now, in terms of what the market is showing us, the system is basically telling us that there's a high probability that we see what's known again as a shallow deflationary environment, at least up front, meaning both bonds and equities can go up. The question is going to be where growth goes. Okay, because we know that inflation is pretty much, I mean, the base effects are going to pull inflation down into the end of the year, unless something absurd happens in between. But the system is telling us that inflation has downside risk. So that puts us into two possible regimes: expansion or deflation. Expansion requires positive growth. Expansion is a risk on regime. It is a regime where equities do well, bonds they do well. They do well as well, but they don't do as well as equities, which is why in risk on expansion you want to be long risk on assets being equities. And then you have the opposite regime, which is deflation, where both growth and inflation are falling. And in that environment, you want to be long bonds. Equities don't tend to do well at all. And you want to be long bonds, specifically the long end of the curve, because you're betting on a recession. That's what a real recession, not an they call it the inflationary bear, the stagflation. A real recession or an inflationary recession, right? Or the inflationary bear is where inflation is up but growth is down, which is stagflation. A real recession is where both growth and inflation are negative, and that's deflation. Now, if that deflation regime is light, meaning growth is not negative enough to really send us lower in terms of the regime mapping, what ends up happening is you have a light deflationary regime, and we saw this in 2019. If we go back to 2019, this whole 2018 to 2019, this whole period here was technically a deflationary. A good chunk of this period was deflationary for markets, and what you saw was bonds outperform equities in the same direction. So, meaning bonds went up, equities went up, but bonds went up at a faster rate over the term of the regime, and this obviously segued into COVID, where which was very deflationary at the start. Then it catapulted from deflationary to inflationary, which we saw obviously equities from that point exceeded beyond belief in terms of returns to in comparison to bonds. Equities were extremely superior, and that's what an inflationary regime is. So where we are right now is we're at a point where we could be in a light deflationary environment depending on the direction of growth, which the system is very good at picking up. The system noticed issues with growth 3 weeks ago now. I think it was mid March, and then within the prior um, in the prior weeks following our notice on growth, the Atlanta GDP tracker fell off substantially. So obviously the system knows what it's doing, which again is why we say we follow the system. We don't front run it. The system said caution on growth, and we listened. And now the question is, does growth really fall apart and really send us into that deeper, or I should say steeper deflationary environment? If it doesn't, what you're going to get is you're going to get both sides in shambles. What do I mean by this? A lot of people on Twitter are saying um, they are unable. So when someone says the market is going to chop, what they are telling you is, I don't know what's going to happen. When they say, oh, it's just chop from here, they don't know what's going to happen. So they just blame it on chop. In reality, even in a choppy environment, there's always a direction in terms of allocation and market trajectory. Meaning, if the market's chopping, look at bonds. Bonds are most likely moving, so on and so forth. Or the market's chopping in solid bullish bearish trends. It's literally not going side. We're not trading in a 500 or 1,000 point range on NQ for the next 12 months. There's obviously some movement. Is the chop going to be, a 5,000 or 3,000 point range? Because even then, that's a wide range. The market isn't going to just sit here and do absolutely nothing for the next 8 months. So again, when people tell you that the market is just chopped, they don't know what's going on and they can't decipher what's happening out there. So they just blame it on chop. What we think is going to happen, like I just said, is both sides in shambles, where those people that are basically saying, "Oh, the market's going to chop," they're going to be sit there confused on why both equities and bonds are moving up, because most likely the conservative individual is betting on bonds right now. They're saying, okay, how much worse could it get in the interest rate environment, and how much worse could it get in the economy? Well, the economy could slow down dramatically, but the odds of rates going significantly higher than here are not as bad or not as high as the odds of the economy slowing. So I'd rather long bonds, right? That's the simple way to do it. And you could say, oh, cash balances are paying close to 5% in terms of repo, the short-term bills. It almost doesn't make sense to own stock. Well, the counter argument to that is, what you saw in the market may have been worst case doomsday scenario in terms of the rapid decline in growth stocks, in market pricing, in inflationary worries, in growth worries. Um, what what would have to happen now for the market to fall apart dramatically lower from here? In turn, and remember what we said, I think it was 2 weeks ago. The market is not, recessions are not 2008. Okay, 2008 was a financial crisis in terms of the entire economic system was on the brink of collapse. That is not a normal recession.
Well, don't you think that's a possibility with the amount of debt that's in the world right now? I know it's a doomsday scenario. It's what Peter Schiff and all these people always talk about. There's too much debt. You raise rates, it's going to cause a crisis. Isn't
Uh,
that a possibility?
I think, yeah, you can have a banking crisis, which we've already seen. But in terms of big banks going, okay. So remember, there's a difference between the current. So the current situation is current banking situation that which we've all seen unfold with SVB is these HTM losses, the held to maturity losses, right? And it's not so much a banking business issue than it is a time issue, because the bank is sitting on those unrealized losses that, unless it has to realize them, will mature at full value, right? So those assets aren't actually down in theory, right? Like, yes, they're down if the bank has to sell it for liquidity concerns, but in the theory of the next 5 years, those assets will mature, or 10 years, depending on the average duration of the portfolio. I think most of them are like 10 years. They'll mature at par, meaning they'll get all their money back. Now, the question is, what can be done to prevent locking in those losses? Because you lock in those losses, they go from paper to real, right? And the Fed has done a good job so far with this BTFP and obviously the discount window and whatnot. They're preventing a So a widespread realization of losses. Let's go back to 2008. You had these mortgage basically these mortgage products, right? We're going to simplify this. You had a basket of mortgage products that were fundamentally default and worthless. Garbage. So there was no mature at par. It was worthless. It was a worthless security on the books. There was no like, oh, I'll wait this out. Like people were defaulting on their homes. There was no the payer will make the payments down the road. That was done. Worthless, right? These are treasuries. These aren't worthless. So we're talking now, right? And right now, the issue right now. So it's such a different dynamic. The banks also have been made stronger since then, and we had again the emergence of something that didn't exist back then to the degree it does now, which is quantitative easing. It did exist, but to the degree we see it now in terms of the Fed balance sheet, there was nothing in 2008. I believe in 2008, the Fed balance sheet was under $1 trillion. I mean, we could see that right here. We'll pull it up right now. So we have the Fed balance, the Fed balance sheet in
Yeah,
2000.
so they have way more ammo
Right,
now to be able to solve worse situations.
right. Going into 2008, the Fed balance sheet was under $1 trillion. Then after 2008, it went up to about $2 trillion. We're currently at $8 trillion. And don't think for a second the Fed has no issue pushing this higher. In terms of if a real crisis hits, in terms of getting liquidity out there, this type of environment that you saw in 2008, not saying that it's not repeatable, but the degree, I mean, you had JP Morgan, you had Citibank all on TV. You had the whole march down to Wall Street with the banking executives going down to the treasury. I think it was the treasury, and basically having hearings on why they were too big to fail, like basically pleading for a bailout. And what you like that doesn't that we're not in that situation again. Again, it's called the GFC. It was a financial crisis. Okay, it was you're talking about not only you talking about banks going under, but people again. Tell me, you're right in a situation. I'm going to break this down again, even to a more basic level. In 2008, I know postal workers. I know that they had 3 or 4 houses. Okay, and they're friends. It wasn't just one guy. It was him and his friends. They all had house. It was easy to get a house in 2008. I mean, you guys remember the loan standards were way different than where they are now. But me bringing this up is you had blue collar workers basically going under left and right. Okay, you had regular Americans going down with the banks at the same time. It's a vastly different situation right now. The banks have a liquidity issue. Does it really affect the mom and pops in this scenario? No, not so much. The mom and pops are really getting hurt by inflation. And not so much the banks going down. And the banks that are going down, they're getting bailed out almost in the same weekend. So who's really getting hurt right now? You could say, oh, yeah, the taxpayer through the loans, FDIC, it's a burden of the taxpayer. Yeah, I understand that. But in terms of like actual regular people, how does it affect you and your neighbor? It doesn't, which is the difference between now and the GFC. Now, could it lead into an event with many different dominoes falling in the future that will push us there? Yes, but we're not there yet, and I don't see us getting there, at least not right now. So in terms of like this crisis that everyone's pitching, in terms of, oh my God, the world is going to end, the death of the dollar, all this noise, you have to cancel it out, and you have to pay attention to what's really happening right now. The dollar is the main world reserve at this point in time, and it will be for the foreseeable future. Demand for US products is going to be big for a long time. If you listen, I said this on Twitter and I'll say this again. You want the dollar to fail? You think the dollar is going to fail and it's going to basically, America is going to be in some would say the America would be in a better position because in terms of world financing and whatnot, but in terms of the stability of our currency, you can make that argument when we see mass emigration of people and companies out of this country, meaning Apple, Google, the top 10, pretty much out of the top 10 companies in the world, I think like at least 8 of them are within America. So if those companies leave this country, you have something to worry about. But they aren't, because America is the land of the law, the land of At least you can argue this all you want in terms of law, business practice, and just economic function. America is superior to most countries, pretty much almost all of them, outside of obviously the comparables being some countries in Europe, Canada, some countries in South America, depending on which ones you pick and how you want to compare them. But in terms of superiority, China is not superior to America in that term. I mean, you don't see anyone leaving America saying, I'm going to go start my business in China. So there's a reason for that. And until something like that changes within this country, within America, I think the fears of the dollar losing world dominance need to stay subdued, and they will likely fade as people realize that it's a bunch of poppycock and it's not really going to happen, at least in the way that people are explaining it. And again, this is because of shills. Shills take these headlines and they feed it into their business model. The dollar's going to collapse. Buy gold. Be ungovernable. Buy Bitcoin. Like that's what they're doing. They're taking this shit and they're shoving it down your throat, making you think, oh God, the dollar, the banking system might collapse. The only way I will be safe is if I buy Bitcoin. In reality, that is not the case. Same thing with gold. Not the case. So if you feed into these things, you're going to develop a fear that is just not realistic. It's okay to be scared. You should be scared about certain things. Could we get into a steeper recession than what I'm portraying to you right now? Yes, but it's very likely we're going to see that data shift as we go along. The market's not going to just open up one day down 35% from here. That's not what's going to happen.
There's a time and place for everything.
Exactly.
Yeah, buying gold is fine, buying Bitcoin is fine, but there's a time and place for it. If that's the only thing that you're buying, you're just not going to make money.
Right, over the long term. I mean, you talk about Bitcoin being down 70+% off the highs. When Bitcoin was 60, 68K, 69K, that you had people telling you it's going to a million. I mean, you still have those people telling you it's going to a million, but my point is, at what point does it make sense to buy it and hold it, or buy it or sell it and not be a part of it? And that's where the regimes, the system, and the models all that we have all come into play, because what they do is they take away that situation they give you situational awareness to what's going on around you. Pay attention to the market. When the market's in a bear market, you don't want to own equities. It's simple, right? When the market's bullish and going up and equities are outperforming, you want to be long equities. This whole perma nonsense of I'm long gold, it's doing good. Again, gold is no higher than it was in 2012. You can claim, yeah, okay, in terms of inflation, it's over the long term, it's hedging it. But in terms of direct scenarios, it is not an inflationary hedge. Okay, you can argue, oh, gold's up right now. Yeah, gold's up right now. Gold's up right now because you literally have headline after headline about the US attempting to go back into the gold standard, which is an impossibility. And let's put politics aside. It's just gaslighting. That's what that is. It's never going to happen. The whole reason we left the gold standard is so we could grow as an economy. You cannot have a currency that is pegged to a deflationary asset. Gold is a deflationary asset. It's not inflationary, because you notice gold's best performing regimes are when we have economic periods of deflation, when real yields fall, because gold and bonds are the same trade. Gold and bonds both go up when yields go down and rate cuts appear. That's when gold goes. That's a deflationary asset. Okay? So if you peg your currency to a deflationary asset, what ends up happening is your currency will perpetually have more and more value as time goes on. Because the component that you're not understanding is, oh yeah, the supply doesn't go up, no inflation. Well, what you end up having instead of supply inflation, you have demand deflation. You have more and more people chasing the same amount of goods, right? So like the same amount of goods being dollars. There's only so much gold that's found every year. If you want to add that to the supply, add that to the reserves being bought, however you want to figure and construct that into your gold model. But there's only so much gold compared to the people that are in America and then within the rest of the world. So then you end up in a situation with an economy that can't grow due to a shortage of currency. It's actually a bad thing. And that's why I think that we will never go back to the gold standard. Not that we can't, it's that it economically makes no sense to be on gold standard. And I think that you have to put your fears aside of what is really going on versus what is being told to you with the ulterior motive of you either subscribing, purchasing, or just going along with the narrative. There really is no point in you betting on a dollar collapse, gold being the new world currency. Again, the reason the dollar is the world reserve currency, the dollar is still shit. It's still a piece of shit, but it's the best piece of shit that's out there. Gold is not a piece of shit. Gold is a deflationary asset, which is why it will never be a world reserve currency. Because to have a currency, you have to have a piece of shit. But you just need the best looking piece of shit to be the world reserve currency. And other than that, I think that's where we'll wrap up this podcast. I hope you guys have or had a great Easter, and we'll see you guys next week.